Hello and thank you for joining me for this on the road webinar focused on the consumer duty. My name is Tom Selby. I'm head of retirement policy at AJ Bell, and I'm going to take you through in the next 30 minutes or so the key components of the consumer duty. So arguably the biggest regulatory overhaul since the retail distribution review about 10 years ago. There are three key tenets of consumer duty, which we'll look at individually. So the new consumer principle, Principle 12, the cross-cutting rules, and the 4 outcomes that flow from the consumer duty, the principle, and those cross-cutting rules. Now, given the consumer duty is arguably the biggest overhaul of regulation for 10 years, it was surprising to read the other day that 1 in 5 advisors haven't heard of it and 1 in 4 advisors aren't considering any changes to their businesses as a result of the consumer duty. Now, the latter perhaps not as surprising as the former, but this is certainly something, given the scale of the change, that all advisors and providers and everyone else in the financial service industry need to get their head round and review. Now, before we get into the meat of the presentation, a few overarching points to bear in mind on the consumer duty. So firstly, this isn't just about our world. So this isn't just about advice, this isn't just about investments, this isn't just about platforms. It covers all retail financial services. So things like banks, of course, general insurance, credit firms, funeral plans, all different corners of the retail financial services industry. So it's therefore not necessarily targeted at our world. And in fact, when you start to look at some of the things that the consumer duty says and the principle says and the outcomes are saying, I think it's probably fair to say that a good advice firm is a benchmark for what the FCA wants to see from the rest of the financial services industry. And I think that'll become clear as we go through the various parts of the consumer duty. This is also as much about a cultural shift as anything else, a cultural shift that the FCA wants to see across retail financial services, but also a cultural shift within the regulator itself. So the regulator moving away from an approach to regulation that focuses on setting very clear rules to one that's focused more on outcomes, although of course those outcomes do exist within an FCA rulebook. A lot of what the FCA is asking firms to do, good businesses will already do as second nature, and I'm sure good advice firms and the advice firms who are listening to this webinar will also already do at the moment. But that doesn't mean you can ignore it. It doesn't mean good firms can ignore it either. Every firm that's operating in the retail financial services sector and under the purview of the FCA needs to review what they're doing, review their processes in light of the consumer duty. And just for your diaries, that the final consumer duty rules are due to be published in July, with implementation at this stage set for April 2023. Okay, so let's get into the presentation. So firstly, why exactly does the FCA need a consumer duty, or why does it feel that it needs to introduce a new consumer duty? So 4 key things that the FCA is worried about here. So let's kick off at the top. So behavioural biases. So the FCA concerned that firms are exploiting behavioural biases. You can see this in various different parts of the industry. So for example, online sales journeys that perhaps push customers towards actions that aren't necessarily in their best interests. Products not fit for purpose, so inappropriate products being sold to people. The FCA specifically cites things like complex contract for difference contracts that have been marketed to retail financial services customers. Go to the bottom of the circle there, we've got products not being fair value. Of course, we've seen that across various different parts of the financial services sector at different times, although what constitutes fair value can to an extent be subjective. Poor customer support. Now, I suspect that's something that many advisors watching and listening to this webinar now will have experienced from their providers. So 1 in 10 people unable to get through to their provider or get the support they need. And all of those factors, along with various other things, lead to a world where consumers don't trust the financial services industry as much as the regulator would like. So only 1 in 10 people say that they strongly agree that they trust the financial services industry, although a further 32% say they slightly agree. So the FCA introducing a new consumer duty to deal with these issues. You could, I suspect, argue that these issues could be dealt with within the existing regulation, perhaps with greater levels of enforcement from the regulator, but the regulator wants to enact a cultural shift amongst financial services firms. So just to emphasize that point on trust, so some figures here from the FCA's Financial Lives survey, a huge piece of work that it conducts every 12 months, looking at levels of trust in different types of organizations. So you'll see financial advisors sat there somewhere in the middle, 5.2 out of 10. Surprisingly, you've got banks at the top at 6.5 out of 10, perhaps because of the simple nature of what they do, and perhaps financial advisors a little lower down in there because there are people who don't receive financial advice who perhaps have a different perspective on what financial advice involves, and one that's maybe not linked to the reality of what the majority of financial advisors do. Pension companies slightly higher there at 5.4, and we'll all be happy to see that we're both pension companies and advisors above the government and social media companies. I think if either were below those two, then you'd be rightfully concerned, but clearly not ideal levels of trust in the industry, and certainly not ideal levels of trust when you're thinking about what consumers are doing and the amount of money that they're placing, or hopefully placing, with financial services providers and with advisors as well. So some problems to be addressed, and here it is in all its glory. The new proposed consumer duty set out in a neat pyramid here by the FCA. So you start at the top of the pyramid, you've got the consumer principle, so the new principle 12 within the regulations, saying that a firm must act to deliver good outcomes for retail customers. So we'll go through each of these different parts of the consumer duty and each of the different individual things that it says here in the rest of the presentation. So that new consumer principle essentially replaces Principle 6, TCF, treating customers fairly, and Principle 7, so the requirement for communications not to be clear, fair, and not misleading. We've then got the 3 cross-cutting rules which are in place and firms need to follow in order to achieve those good outcomes for customers that the FCA wants to see. So firms must act in good faith towards retail customers, avoid foreseeable harm to retail customers, and enable and support retail customers to pursue their financial objectives. And then those 4 key areas, those 4 key outcomes that within which the FCA wants to see good outcomes. So that's products and services, price and value, consumer understanding, and consumer support. And we're going to work our way down that pyramid, hopefully putting a bit of meat on the bones of what are some admittedly quite woolly concepts set out by the regulator as part of its consumer duty. So let's kick off then with the consumer principle, and I was drawn to this comment from Sheldon Mills, the Executive Director, Consumers and Competition at the FCA, that he made recently at the Buildings Society Association conference. So this is what the FCA wants from the industry. I encourage you to put yourself in your members' shoes, so your customers' shoes, and ask, would I be happy to be treated in the way my firm treats its customers? Would I recommend my firm's products and services to my friends and family? Would it be easy for the typical customer to understand whether my firm's products and services suit their needs? So what the FCA is talking about here is an aim at embedding a culture of aiming for good outcomes within all firms by putting yourself in your customer's shoes. And again, as I said at the top, good firms are already likely to be doing a lot of this stuff, and a lot of it will feel like common sense to a good advice business. So specifics, the consumer principle requires firms to proactively seek to deliver good outcomes for consumers generally and put consumers' interests at the heart of their activities. Focus on the outcomes consumers actually get and act in a way that reflects how consumers actually behave and transact in the real world. So looking at those behavioral biases there, better enabling them to access and assess information and to act to pursue their financial objectives. Ensure they have sufficient understanding of customer behaviour and how products and services function to be able to demonstrate that the outcomes that would reasonably be expected are being achieved by those customers. And a few of these concepts we'll get on to in a minute, including what can reasonably be expected. Where firms identify that good outcomes are not being achieved, act to address this by putting in place processes to tackle the factors that are leading to poor outcomes. So review processes in place to make sure and check what's being done is leading to good outcomes, and when there aren't good outcomes, doing something about it. And finally, consistently challenging themselves to ensure their actions are compatible with consumers' interests and financial objectives. So a lot of common sense in there, and as I say, a lot of things that I suspect good financial advice firms and good firms in retail financial services generally will feel that they're already doing. So let's pick up on a couple of those terms. So the consumer principle, as a reminder, says a firm must act to deliver good outcomes for retail customers. The FCA explicitly says that it believes and it wants this to be a step up in expectations compared to Principle 6 and Principle 7, so treating customers fairly and the requirement to be clear, fair and not misleading in communications. However, as the second bullet point here states, now as I'm sure you've thought already, achieving good outcomes for everyone in every situation and over every time period is clearly impossible. Certainly when you think about someone who's investing for the long term, it's likely that the value of their fund is going to go down as well as up, particularly over the short term, and particularly if they're taking reasonable levels of risk, as should be the case for many people, particularly in the early stages of their retirement savings journey. So how firms should go about achieving good outcomes, and crucially the intended limits on firms' responsibilities are set out in a bit more detail in the cross-cutting rules, which we will come to. But the whole consumer duty is underpinned by this concept of reasonableness. Now, that is a concept that is inherently difficult to define. So the FCA wants firms to aim to achieve good outcomes within what could reasonably be expected of those firms. But what's reasonably expected of different firms and different actors in financial services will depend in part on the size of that firm and the resources it has at its disposal, and in part on the closeness of that firm to the end customer. So it's in its nature a woolly concept. The FCA says the standard reflects the tortures, so the legal concept of how a reasonable, prudent firm would act, and is one firms are already familiar with under common law. So while the FCA thinks that the standard is not unobtainable, ultimately what is reasonable will depend on different firms. It will vary from firm to firm and from industry to industry, and it will require interpretation both by individual firms, by the regulator, crucially, I think, as we move forward, by the Financial Ombudsman Service, and possibly eventually in the UK courts as well. I think one of the big dangers in all this is that by setting a standard for firms of achieving good outcomes for customers, we'll see claims management companies leap onto that and look to pursue spurious claims against firms where any outcome that is perceived of as being poor is witnessed, even if that outcome is over a very short period of time and isn't taking into account a client's or a customer's longer term objectives. So the FCA sets out some factors that affect what will be deemed as being reasonable, and we've touched on a couple of these already. So the nature of the product or service being offered, so where it's more complicated, where there's a higher risk of consumer harm, or where costs and charges are high, then the extent to which the firm will need to do checks to make sure it's achieving that good outcomes aim will be higher, the expectations of firms will be higher. Equally, the characteristics of consumers in the firm's target market, so where there are sophisticated investors versus novices or those who might be more vulnerable, the expectations will be different. And where the firm sits in the distribution chain as well. So where, for example, you have an advisor who is very close to the customer, the expectations might be higher than with a non-advised firm that isn't as close to the customer, because the amount of information, the knowledge and understanding of that client's circumstances will, by its nature, be higher for the advised customer who is close to that advisor. Okay, so now let's move to the second section of that pyramid we saw at the start, the cross-cutting rules that firms are required to follow in order to aim to achieve those good outcomes we talked about at the top. So quick reminder of what they are. So firms must act in good faith towards retail customers, avoid foreseeable harm to retail customers, and enable and support retail customers to pursue their financial objectives. And again, some less than clear concept. I think it's fair to say within those cross-cutting rules, but we'll try to just pick apart one or two of them. So firstly, in the regulator's own words, what it says about the cross-cutting rules. So when consumers deal with financial services firms, the concern is that there is generally an imbalance in bargaining position, knowledge and expertise. Consumers can only be reasonably expected to take responsibility for their choices and decisions if firms act openly and honestly, avoid causing customers foreseeable harm, and take proactive steps to empower customers to make good choices. And just emphasising that point, the entire consumer duty, including these cross-cutting rules and the 4 outcomes, is underpinned by a concept of reasonableness, or what a firm can reasonably do within its regulatory powers and in relation to its relationship with that end customer. Okay, so let's pick up the different parts of those cross-cutting rules. So we've got a reminder of the cross-cutting rules on the right-hand side of the slide. So firstly, acting in good faith towards retail customers. Now, this is something that you would absolutely expect all firms to be doing, certainly all good firms. So this is a standard of conduct characterised by honesty, fair and open dealing, and consistency with the reasonable expectations of customers. The FCA expects a firm to act in good faith at all stages of the product journey and across the entire product life cycle. The FCA makes a point here of emphasising the fact that bad faith, so clearly the opposite of good faith, includes any attempt to exploit behavioural biases. So this isn't just about following word for word the FCA's rules, it's about the actions that firms take and how they may or may not try to exploit the nature of human beings. The second of the cross-cutting rules, so avoiding foreseeable harm to retail customers. Now, this is a really tricky one, because what is foreseeable harm? Indeed, what is foreseeable and what is harm? Over what time periods are you judging harm, and what things can reasonably be deemed to be foreseeable by different financial services firms with different knowledge of the customer's position and a different understanding of their overall financial situation. So the FCA says the focus of this cross-cutting rule is on firms not causing harm to customers through their conduct, products or services, and acting to avoid it. Now, crucially, the FCA says this is not intended to create an open-ended liability or protect customers from all harms. It doesn't require firms to protect customers from unforeseeable harm or poor outcomes or risks that customers reasonably understood and accepted. And those should include the risks associated with investing for the long term. But as I said, there's certainly a possibility that certain firms will use the foreseeable harm and the good outcomes parts of the consumer duty in order to pursue claims that really shouldn't be being pursued. We hope that isn't the case, but I think the proof of the pudding there will be in the eating. Now, the final of those cross-cutting rules enable and support retail customers to pursue their financial objectives. So the focus here on enabling and supporting consumers to make effective choices for themselves and enjoy the use of the products and services they've purchased. What's required of a firm will depend, of course, as I've mentioned, on a firm's role and knowledge of customers. So again, a fairly obvious example, but an advice firm with advice positions dealing one-on-one with a client will be expected to provide more support to a customer than, for example, a non-advised or execution-only firm. And I think that's self-evident. Okay, so we'll move now to the bottom of the FCA's pyramid and look first of all at the products and services outcomes. So the first of the 4 outcomes that the FCA wants to see in relation to the consumer duty. Now, this primarily relates to product providers, although clearly there are advice firms that work jointly with providers in producing funds, for example, and the distributors clearly still have a role in the quality of the products and the appropriateness of the products that they distribute to their clients. So in the FCA's words, again, we want all products and services for retail customers to be fit for purpose, makes sense. We want products to be designed to meet customers' needs and targeted at those customers, and those products being clearly targeted is one of the key concepts that we're going to look at here. By setting high but attainable standards, the FCA expects to enable better and healthier competition and innovation between firms. Well, we'll see if that ends up being the case. While firms will need to apply the rules for all products or services, the requirements are less onerous for simpler products with less risk of consumer harm. So again, getting to that point of reasonableness there, so where a product has less risk of harming customers, then the amount of checks that firms need to do on that product or service will be lower than where the risk of harm is more significant. Now, looking specifically and in more detail at the products and services outcomes, so firms required to consider the needs, characteristics and objectives of customers in their target market when designing a product or services. So different requirements depending on whether you're a manufacturer of a product or a distributor of a product. I suspect the majority of people listening to this will be the latter rather than the former. Some will clearly be both, as I mentioned, so where advisory firms work with a fund manager to create an investment fund. I draw your attention to a couple of the proposed requirements on the right-hand side of the slide, looking specifically at the proposed requirements for distributors. So those are the ones that are most likely to be relevant. So develop distribution arrangements for each product or service distributed, get information from the manufacturer to understand the product or service, its target market and its intended distribution strategy, and regularly review. So again, common sense, I suspect all good firms will be doing that, but worth checking and reviewing what you're doing to make sure it's in line with that product and services outcome. So just again, this is handy. The FCA both shows us case studies in the non-handbook guidance, which I'd urge you to read. If you don't want to go through any of the rest of the consultation, I'd urge you to have a look at the non-handbook guidance. And it also looks at some of the actions that are likely to be consistent and inconsistent with the consumer duty. And we'll pick up a few of these in the latter part of the presentation. So actions likely to be consistent with the consumer duty, you can see them on the right-hand side there. So a target market being clearly defined and identified for the products or services that are being distributed, and the product being tested to make sure it meets a consumer need, the product being distributed within its intended target market, so sold to the people it's meant to be sold to, and where any issues arise, those issues as part of a review process or a review process that the regulator wants to see across all firms, where those review processes identify issues, those should be addressed and dealt with as efficiently as possible. A couple of examples here that the FCA sets out, or 3 examples. I'll draw your attention to 2 of them that might be most relevant. So an investment fund, the top bullet point here starts with a target market described in terms of investment objective and risk. However, the target market should be refined and clarified if the product is generally incompatible with the needs, characteristics and objectives of people who cannot commit to hold the investment for more than 5 years, or who cannot afford to bear potential investment losses. So the focus here very much on honing the target market of an investment fund to the people for whom it is most likely to be appropriate, and keeping it away from those for whom it's likely to be less appropriate. If we look at the example at the bottom, so the initial target market for financial advice firms services might be any consumer with a potential pension investment need. However, the inclusion of fixed minimum fees in an advisor charging model mean the target market should be refined to exclude customers with very small investment amounts, i.e. those for whom that fixed minimum fee would take up too large a percentage of their overall fund and would potentially not represent good value. And that takes us neatly to the price and value outcome, the second of the outcomes. So the price and value outcome, in the FCA's own words, we want all consumers to receive fair value, and that's important, fair value. Value needs to be considered in the round, and low prices do not always mean fair value. I think that's obvious to most people in the advice sector, but useful that the FCA specifically clarifies that point in its thinking. The FCA expects firms to think about price when assessing fair value, but again, not at the expense of other factors. So price, very important in the value calculation, but clearly not the only factor. Finally, complex and opaque pricing techniques or engaging in practices that discourage customers shopping around are unlikely to be consistent with the consumer duty, and frankly, you wouldn't expect them to be consistent with any consumer duty or any regulator's intentions. Now, what does this mean for financial services? Well, it looks like we're going to see an extension of the value assessments that we've seen in the investment industry. So for products manufacturers, fair value must at least include an assessment of the nature of the product or service, any limitations that are part of that product or service, the expected total price customers will pay, and this is a concern that the FCA raises throughout the consultation, any characteristics of vulnerability in the target market for the product or service. So wants to be very clear that those who are more vulnerable need to be protected from poor value, poorly priced financial products and services. In terms of distributors specifically, so distributors must not distribute products or services unless they are satisfied that their distribution arrangements are consistent with the product or service providing fair value. Again, that's something that would be inherent and intrinsic in the work that any good advice business does. So again, looking at the actions likely to be consistent with the consumer duty. So a firm carrying out a value assessment, a review of the impact of any changes that happen in relation to the value of the product or service that's being provided. Where issues are revealed as part of a review process, steps are taken to deal with that. A firm considers the reasonable of its product range and whether each product provides fair value to the customers in the target market. So again, target market key here. And finally, differential pricing is okay. The FCA explicitly says differential pricing is okay, provided that each different person, each different customer group is receiving fair value for the price that they're paying. And again, some examples here of different firms involved in the distribution chain of an investment product and the responsibility that they'd hold in relation to providing fair value. And again, I'd encourage you to go to the non-handbook guidance and have a look at some of the quite specific and detailed guidance, and those are going to be updated by the regulator both now and into the future. So the consumer duty very much intended to be an iterative piece of regulation that changes over time. So moving on to the consumer understanding outcome, again, let's have a quick look at what the FCA says about that. So the proposals build on and go further than, and that's key here, go further than Principle 7. So that is the principle of communications being clear, fair, and not misleading, by requiring firms to focus much more on consumer outcomes and understandings throughout the customer journey. Firms should monitor, test, and adapt communications to make sure they remain effective. And again, monitor, testing, and adapting, that's something that we see throughout the 4 outcomes. Firms need to consider their overall approach to communicating information, so clients are equipped to make effective, timely, and properly informed decisions. Now, there was some hope that because the focus here is very much on outcomes, and because a lot of the prescriptive disclosure that exists through regulation and legislation, that perhaps this could open the door for firms to ditch existing disclosure requirements which are deemed not effective and not in line with the consumer understanding outcomes. Sadly, not the case, although clearly there is the possibility that those requirements, particularly in the FCA's world, will be reviewed in light of the consumer duty. But that shouldn't stop firms thinking about the purpose of their communications and the outcomes that they're focused on. So it's possible, for example, that you could add extra information, so things like explaining jargon or signposting to extra detail to the existing prescriptive requirements in order to improve your client's understanding of the information that you're providing to them. And again, I suspect all advisors will be doing this already. Communications should be tailored where possible. Again, this is aimed more at, I think, larger organizations that might send blanket communications to people rather than focusing them on specific types of customers. Crucially, the effectiveness of communications, so how well those communications you provide to your customers, should be tested. Not all communications will need to be tested. Again, that concept of reasonableness and the extent to which consumers might be harmed by the communication will be paramount in deciding whether or not that testing needs to take place. So again, looking at the actions consistent with that consumer understanding outcome, I'll be brief here, but you're free to read through these at your leisure. So put yourself in the customer's shoes and ask if the communication that you're receiving would allow you to make effective decisions. If you're providing engaging content for customers, by layering information, for example, making sure it's relevant, simple, and timed well, that's likely to be consistent with the consumer duty. Segmenting your communications and targeting them at certain groups of customers who are most likely to benefit from those communications, likely to be viewed in a positive light from the regulator. Again, proactive testing, so thinking about the communications that you send proactively and then testing those communications as well to make sure they work, and where they don't work, then you look to introduce remedies or simply remove the communication altogether where it isn't a regulatory or legislative requirement. And again, 2 examples here. I won't go into those in detail, but feel free to read them at your leisure. And again, I strongly suggest that you look at some of the examples that sit at the end in a non-handbook guidance. And now the final outcome, the consumer support outcome. So the FCA says, again, in the FCA's own words, consumers can only pursue their financial objectives where the firm supports them in using the products and services they've bought. A product or service that a customer cannot properly use and enjoy is unlikely to offer fair value. We want firms to provide a level of support that meets consumers' needs throughout their relationship with the firm. This means firms' customer service should enable consumers to realise the benefits of the products and services they buy and ensure they are supported when they want to pursue their financial objectives. Nothing I think that anyone would disagree with there. So in relation to that outcome for the products and services outcome, the firms must ensure they provide an appropriate standard of support to retail customers such that it meets the needs of consumers, enable retail customers to use products as reasonably anticipated, do not place unreasonable barriers in the way of customers reaching their financial objectives, regularly monitor whether they're providing an appropriate standard of support to meet the needs of customers and to make sure they don't disadvantage customers. And then we move on to those examples again. So actions likely to be consistent with the duty on the left-hand side of the slide, and then a couple of examples, one of good practice and one of poor practice on the right-hand side of the slide. So in terms of actions likely to be consistent with the consumer duty, so firms have processes that support customers throughout the product and service life cycle. Firms design and deliver the support they provide in a way that enables customers to realize the benefits of the products they buy. Firms have effective consumer support process and communication strategies to deal with unexpected surges in demand for support. So all of this is meant to mean that consumers find it easier to get the support they need from firms. And again, all of this is underpinned by what a customer could reasonably expect a firm to do when supporting them in achieving good outcomes. Okay, so let's wrap things up with the help of Jerry Springer on the right-hand side there. So just a few final thoughts. As I said at the top, this isn't just about our world. These regulations cover all of retail financial services. As I said, I think good advice firms and the way that they communicate with customers will be the gold standard that the FCA is wanting to see across other industries. This isn't just a test for the financial services industry. As I said, it's a test for the regulator and a shift in approach for the regulator from one based largely on following rules to one based on achieving good consumer outcomes. One big question around this and the success of the consumer duty in achieving its aims is the extent to which good firms will continue to be good firms and will adapt where necessary to meet the consumer duty, and bad actors will continue to be bad actors. And I think there's a pressure on the FCA in introducing the consumer duty to make sure that where firms continue to flout the rules, that they feel the full weight of its enforcement division. The Financial Ombudsman Service, the FOS I mentioned, likely to have a big role to play, in particular in determining what harm is foreseeable and what firms should reasonably be doing to protect consumers and ensure they achieve good outcomes. As I mentioned, good firms should still review their process and communications to make sure they're in line with the consumer duty. I think we can all agree that if standards across the board are raised and trust in financial services is raised as a result of the consumer duty, then that will be a good thing. But whether or not that happens depends not just on the industry being regulated, but also on the actions of the regulator itself. And I could do a whole other presentation on this, but we don't have time. The big question remains on the advice guidance boundary, and I think the extent to which non-advised firms can provide the level of support that they perhaps need to in line with the consumer duty to customers while staying on the right side of the advice guidance boundary, and in particular getting closer to that boundary perhaps than we see firms get at the moment. So that's it, slightly over 30 minutes. I apologise. I hope you found that useful. Thank you very much for tuning in, and goodbye.